And history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more.
While everyone is predicting market crashes, I think the best thing to do is to learn from the best in terms of how they prepare for market crashes and how they capitalize on those opportunities. I find that the more prepared I am, the more confident I'll feel when the opportunity inevitably shows itself. One of my all-time favorite investors to learn from is Peter Lynch. So let's listen to what he has to say, especially around what to do during market crashes. I've added some of my own commentary throughout the video to make it easier to digest. And no, this video is not financial advice or recommendation to do anything. It's just general information for entertainment purposes.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. People tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
I think it's a timeless principle that the market will go down from time to time. But why exactly is that a bad thing? It's only a bad thing if you need the money. And then you'll be constantly checking your portfolio, losing productivity and your own sanity along the way. It might sound a little bit crazy, but when the market crashes, I get extra excited. Because the companies I like will go on sale and I get to buy them at a discount.
After all, I've trained my whole life to never buy things at full price because it's too expensive.
On the second point Peter made, no one really knows what's going to happen tomorrow, especially in the stock market. But every year, without a doubt, there will be always someone predicting a crash of the century. Of course, everyone's circumstances are very different. And if you're closer to retirement age, it's probably better to go speak to a financial advisor and get some help to balance out that risk profile of your investments. For millennials like me, these crashes are incredible wealth transfer opportunities, as long as you understand what you own. And we're going to talk more about understanding what you own in just a second.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point, data I/O array processor with an optimizing compiler, a 16 dual port memory. Now, if you own a piece of crap like that, you will never make money. Never.
Now, I am 100% on board with the point that if you don't understand what you own, especially if you can't explain it to a 10-year-old what you own, then you probably shouldn't own it. And in a way, when stocks go down, that's why people panic sell, because they never bother to understand the core value proposition of the business they put their money in the first place. Unfortunately, I was one of those people early in my investing career. I bought Northern Star Resources, which is a gold miner, at $3.50 when I first started investing. And because I didn't know what I owned, when it dropped to $3, I panic sold. Had I held it after all these years, that stock would have been 10 bucks and I would have more than tripled my money. At the end of the day, stocks are not pieces of paper where you shuffle around. When you invest in a company, you are a part owner of that company that generates jobs and provide a lot of value for our society. At the same time, I do want to say that just because you don't understand something or a business is a little bit harder to understand than usual, it shouldn't discourage you to go learn about that industry. The talk Peter gave was in 1994. Internet was a thing, but wasn't as accessible as it is today. You, on the other hand, have a device in your pocket that will enable you to learn something so fast that people back in the 90s will have to take months to read up on just to get to the level of understanding you could by watching a 15-minute YouTube video. So there is absolutely no excuse to not know what you own in your portfolio in today's day and age.
Somebody will come along with more whetstones or less whetstones or a bigger mega flop or a smaller mega flop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research, they bought a piece of junk, they didn't look at the balance sheet, and that's what you get for it.
Instead of hearing a tip on a bus, it's now on Reddit or a stock forums. There is nothing wrong when it comes to discovering ideas on these platforms, but take the time to understand what it is that you own. Because when you do, you sleep so much better at night when the market inevitably crashes in the future. And while everyone is panicking, you know exactly what to do.
So there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, you know, but you had to study this. You don't need this in the stock market. So all you have to know is it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well.
There is seriously always something to worry about. When the pandemic crash happened in March 2020, there was even more predictions when it comes to crash of the century. And I was so tired of hearing all of the negative mumbo jumbo. Especially if you're in Australia, the prediction of a housing crash just got so much louder. Now, I'm not saying that the probability of a crash is 0. I'm just saying that no one really knows how and when that is actually going to happen. What's more important, being highlighted by Peter Lynch, is that as long as you understand what it is that you own and you focus on owning great companies, you'll be just fine. But what I don't agree with Peter Lynch is that you should completely tune everything out. I think it's important to be aware of what's happening in the world, especially how the world works. Because all of those things help improve the quality of your decisions.
There's a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16 and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? I've tried prayer, that hasn't worked. So if you don't understand the company, you have this problem when they go down.
I mean, seriously, how much further can it go down? And generally that sentence it goes together with this meme.
Eventually they always come back. This one doesn't work either. A lot of double knits never came back. Remember those beauties? Floppy disks, Western Union, the list goes on and on. People saying it'll come back. Well, it doesn't have to come back.
Well, what we have to understand is that there is always a probability for things to go to 0, and it doesn't necessarily have to bounce back. But we want it to bounce back because we're invested in it. And Peter Lynch, in just a second, will talk about when is the right time to sell.
The important thing is you can't get too attached to a stock. You have to understand there's a company behind it. You can't treat this like your grandchildren. You have to deal with the stock and say, I understand the company, and if it deteriorates, if the fundamentals slip, you have to say goodbye to it. If one rule you want to remember is the stock does not know you own it.
Again, what Peter is highlighting is you have to understand what it is that you own in your portfolio. Because regardless of whether the market is crashing, if the fundamentals of a company changes, it's not the same company anymore. And you have to decide whether you want to keep being an owner in that company.
You need an edge to make money too. People have incredible edges and they throw them away. I'll give you a quick example of SmithKline. This was a stock that had Tagamet. Now, you didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine. But you could have bought it 2 years after the product was on the market and made 5 or 6 times your money. I mean, all the druggists, all the nurses, all the people, millions of people saw this product. And they're out buying oil companies, or drilling rigs, It happens.
What Peter is highlighting here is that we all have an edge that's specific to us. Think about your background, your education, and the things that you do on a day-to-day basis. All of those things give you an incredible edge to analyze specific companies. For example, my background is in e-commerce, digital, and startups. So I would say that I have an above average edge in understanding e-commerce related businesses. And because of that, I have companies like Hims, Ozone, BarkBox, and Amazon in my portfolio. But what I don't have are things that I'm just not interested in, like for example, oil and gas companies. The good thing being a retail investor is that I get the luxury of a long time horizon and let these good companies pan out the way they're supposed to.
And then 3 years later or 4 years later, Glaxo, even a bigger company, it's a huge company, a British company, brought out Zantac, which was a better, at that time, an improved product. And you could have seen that take market share, do well. You could have bought Glaxo and triple your money. So you only need a few stocks in your lifetime. They're in your industry. And that's what bothers me. There are good stocks out there looking for you, and people just aren't listening, and they're just not watching it.
Yeah, you really don't need that many stocks in your lifetime in your portfolio. Buffett had a handful that delivered the majority of the returns in Berkshire. And similarly, I will argue the same thing for ARK as well. A handful of those stocks, like for example, Tesla, Twilio, and Square, deliver major returns for the ARK Invest portfolios. So leverage your own background and your interest to sharpen your edge. Maybe the opportunity is right in front of you. The last thing Peter Lynch taught me on how to invest if the market were to crash again is that you have plenty of time to decide on an investment. I'm going to tie this back to IPOs in just a second.
Is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 it went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You want to check, you see them operate in small towns, you're afraid they can only make it in 7 or 8 states, you want to wait till they go to more states, you keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this.
There's been an incredible amount of IPOs over the last few years. Airbnb, DoorDash, Snowflake, and Coinbase. And people often ask whether I'm going to get in on any of these IPOs. And to be honest, I always think to myself, what's the rush? There are plenty of time for me to do my due diligence, listen to CEO interviews, and understand what exactly am I getting myself into. IPOs often get incredibly hot when it does get listed, and then it simmers down. There'll be plenty of opportunity to invest in these companies throughout market cycles. Like Peter said, you could have waited 10 years after Walmart IPOs and made 35 times your money. Or you could have waited 3 years before you invest in Microsoft to 10x your money. So why the rush? So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces